In this video, we're going to talk about Muln Automotive, trading under the ticker symbol MULN. At the moment, the financial market is very volatile, and we got to be careful about which stocks to buy, which ones to sell, and which ones to keep on our watch list. This video is going to cover the recent price actions and the technical aspects of the stock. Before the video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock increased to $1.37 before closing the trading day at $1.24. We should pay attention to the 79 cents nearby because it was tested one time as a support, but it is part of the proof that the trend may be reversing after a fairly long period of share price decline, which is a significant level to watch out for. Over the past 30 days, the trend of the stock has been bottoming out from the tail end of a bearish trend, making the stock an interesting purchase target. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bearish, as the stock lost almost 90% of its value over the course of the past 6 months, which is likely caused by the market-wide sell-off, but it just hit Muln so much harder. When we look at the price trend overall, it's been rebounding and speeding up, proving that the market and shareholders also want to see the stock level going higher after the recent good news coming out of the company itself. The trading volume of Muln Automotive has recently been around 215 million shares versus the average volume of 127 million shares. Over the previous 52-week period, its price fluctuated between 52 cents and $15.90. The market cap of Muln Automotive is currently at $37 million versus the enterprise value of $113 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is allocating to the company based on the current fundamentals, leverage, market mood, and the company's own asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst market participants, the asset value may be impaired. But with that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements. So it's less reactive than the market cap, and often more lenient for some type of companies, especially the growth type companies. One key element to note regarding the enterprise value is that sometimes the most significant asset a growth company can own is the goodwill. Goodwill is basically an expectation of the market that the company can generate more profit or to have more growth than another company, because it is assumed that it has a better management team, a stronger brand recognition, and a bigger online following. It is basically what makes a company unique compared to the alternative competitors. It's not a tangible asset that companies can use, but it's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, since the enterprise value is also less reactive to the market cap. If the company goes to liquidation, there would be no goodwill, and we would be left with potentially less assets to distribute than the number on balance sheet. When we compare the current price to historical price fluctuations, the stock is 137% higher than the 1-month low, 137% higher than the 3-month low, and 137% higher than the 52-week low. On the options market, which often gives a hint on the market sentiment about where the stock price is likely going to head next, the implied volatility is 375% versus a historical volatility of 354%. The put-call volume ratio is currently 0.16, and for most stocks, they also tend to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 43,000 contracts a day versus the 30-day average of 18,000. In terms of open interest, the most recent volume of open interest has been 143,000 contracts, compared to a 30-day average of 34,000 contracts. In terms of its shareholder structure, institutional shareholders own 4% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. It's relevant to understand the shareholder composition of a company because it helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, then this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. Obviously, there's a lot of exceptions, since many great titles are also held by retail traders for the most part, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price goes lower. When there are significant short interest in the total volume, this is a sign that there's an organized shorting operation going on. The current short interest is 6% of the total float and 37% of the transactions coming out of the dark pool. Overall, my opinion on Muln Automotive is bullish because the stock is still very low compared to historic levels, and because the market has given some pretty clear signs that it will now rebound from there. The maximum exposure I would therefore recommend is 1 to 3% of your portfolio. And for the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are very close to where the stock is. I would recommend to separate your allocation in batches of 25% at a time, so that you can have enough room to purchase later in case of rebounds or retracements. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks been shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.